Welcome to the CLS Market Review for the week of July 1st, 2013. I'm Chelsea Hartness, in for Matt Harwell, who has the week off. The winning streak has been broken. After 7 consecutive months of price gains, the S&P 500 posted a loss for the month of June, losing just over 1%. Nonetheless, this major market benchmark, mostly comprised of larger domestically based companies, is still up nearly 14% on the year. Smaller companies also lost ground last month, losing less than 1%, but they too still show a gain of almost 16% for 2013. International stock market performance continues to lag the domestic stock markets. The global stock market, subtracting out the U.S., lost over 4% and is now down ever so slightly. Emerging market stocks fared even worse, losing over 6% in June. They are now down nearly 10% for the year. Fixed income securities also had another difficult month. The domestic investment-grade bond market lost almost 2% and increased its negative year-to-date return to over 2%. 10-year Treasury yields moved again sharply higher last month, finishing at 2.49%, up another 0.3% in June. For more on current market activity and why investors should stick with balanced, diversified portfolios, we go now to our Chief Investment Officer, Rusty Vanneman. Rusty.
Thank you, Chelsea. June was indeed another interesting month in the markets. And it wasn't an easy month for most portfolios either. Even balanced, diversified portfolios slipped backwards. For example, let's look at this series of target risk indices from Morningstar. These indices are fair representatives of balanced multiple asset portfolios as they contain exposure to international stocks, commodities, and fixed income. In short, each target risk index is trailing the S&P 500 by considerable margins so far this year, even the aggressive target risk index. This index, which is entirely composed of growth assets such as stocks and a small percentage of commodities, and contains no fixed income, is lagging the S&P 500 by a remarkable 6% through the first 6 months of the year. For many, it's difficult to stay balanced when a single asset class such as domestic large caps is doing so well. Given numbers like these, many investors are wondering why maintain a balanced portfolio? In other words, why hold a portfolio of various asset classes? The answer is that for most investors, balanced portfolios typically provide better investor experiences over time. Let's lean on another Morningstar statistic to help explain. Morningstar has a statistic called investor return. An investor return is different than a total return. An investor return takes into account all the money that goes in and out of a security. Returns are weighted more heavily for portfolios when they have more assets. It is essentially a dollar-weighted return and captures the actual return that investors earned. Given that investors chase performance, meaning they buy securities after they've gone up in price and sell after securities have gone down, investors' returns are typically lower than total returns, sometimes by a lot. Emotional investing, chasing performance, is the #1 reason why investors have poor experiences. When it comes to long-term investing, a disciplined approach using balanced portfolios can help, and it has. In fact, looking at data over the last 3 and 5 years, and using data through the end of May, balanced portfolios have indeed provided better investor experiences than portfolios that simply focus on a single asset class. CLS analyst Rui Wang crunched some mutual fund data and discovered 2 things. First, balanced mutual fund portfolios had a better gap between the total return and investor return than single asset mutual funds. To say it another way, investors didn't tend to make as many emotional decisions and chase performance when they owned balanced portfolios. They were more likely to stay the course. The second point Rui uncovered is the investor return was actually higher for balanced portfolios over the last 5 years. This is during a time of a severe bear market and historic bull market. So, holding steady and staying the course evidently paid off during this time frame. Even over the last 3 years, the investor return was nearly identical for the typical balanced portfolio category as it was for the typical equity mutual fund peer group. This is incredible given the strong stock market gains over the last 3 years. In sum, balanced portfolios tend to provide better investor experiences, and I continue to believe that will be the case moving forward. Okay, so let's tie some of the points I made earlier together. First, why have balanced portfolios underperformed the U.S. stock market by so much this year? Second, if the biggest problem investors have is chasing performance, which market should investors probably consider buying and not selling? To help us consider these points, let's review a series of charts created by CLS analyst Grant Engelbart. First, here's a chart of the Morgan Stanley All-Country World Index minus the U.S. stock market. The index we use for the United States is the Russell 3000, which is superior to the S&P 500 and the Dow Jones Industrials, as it incorporates mid and small cap companies in addition to large caps. This chart examines the rolling 6-month relative performance of international stocks versus U.S. stocks. When the line is going up, that means international stocks are outperforming. And when the line goes down, that means domestic stocks are outperforming. Currently, international stocks have lagged the U.S. market by nearly 15% over the last 6 months. That's a lot. Could this underperformance continue? Of course it could, but looking over the last 12 years, when international stocks underperformed by this much over such a short period, they tended to sharply snap back thereafter. This does not look like a time to abandon international securities. Let's break down the All-Country World Index a bit more. The index is composed of both developed markets, such as Europe and Japan, and emerging markets, such as China, India, and Brazil. Let's break out emerging markets next. Emerging markets have been the darlings of the investment world in recent years, collecting more than their fair share of investor flows. This next chart looks at the rolling 6-month relative performance of emerging market stocks versus U.S. stocks. In this case, the underperformance has been even more dramatic, down 20%. This is incredible, really, but we've seen it before. As you can tell by the chart, the last 2 times we've seen this, emerging markets were able to outperform the U.S. market by over 30% within the next year or two. This does not look like a time to abandon emerging market securities. The markets, like many things in life, are cyclical. Things go up and things go down. Knowing investor tendencies and how markets work, staying balanced with a disciplined multi-asset portfolio likely remains the best course of action for most investors, and perhaps as much as ever given recent market action.
Thank you, Rusty. As a reminder,
Chelsea, hey, where's Matt this week?
That's actually a great question, Rusty. Let me just see if I can find the email that Matt sent me this morning. Oh, here we go. Chelsea, out trying to secure a role in Anchorman 2. It's all I've ever wanted. Please cover the news desk for me. That's all I got.
I should have known.
And with that, we conclude our update for the first week of July. As a reminder, our new weekly market review podcast debuts today on iTunes, hosted by myself. Also look for our quarterly market review later this month on clsinvest.com. We hope you have a wonderful holiday. We'll see you back next Tuesday with legendary anchorman Matt Harwell. Have a great week.